Not to a degree, no, because unfortunately the kind of increased uncertainty on the political side keeps us focused very much on the greater, let's say, degree of certainty on the economic side, particularly looking at it from the EU point of view. For cable, as Cherie said, we back that call 100%. We do think that probably US dollars better there on the cable, but in relation to EU, I mean, these guys are facing their own issues, and again, his point about Gibraltar and Spain is very, very valid, and particularly Italy. Italy has got the potential from an issue to become a crisis on a monetary aspect, and for us, it just, even though we have the Germans, for example, effectively baying for tighter monetary policy given inflationary pressure, the ECB is very much hamstrung in relation to keeping its QE going. Obviously, it's containing it, but it's very much continuing to go. So, from an FX cross flow, it's definitely sterling versus euro for us.
Yeah, you reckon that central banks are the biggest challenge, if you want to use that word, for the markets to deal with at the moment, because we do have still a fair bit of convergence going on in this part of the world where I am, in Australia and New Zealand. There's still talk of course, interest rate cuts going forward, but then of course we have the Fed hiking next month in December. What will they do in 2019 still remains to be seen. But how do you trade with so much central bank divergence going on?
Well, I mean, you've hit the nail on the head. The underlying story still is central banks, and that hasn't changed, regardless of some of the big headlines that come up. The Fed is in a very unique situation, and it's unique from a history point of view. It's still carrying about $4 trillion worth of debt in its balance sheet in government securities. So it was interesting yesterday when you had the head of Bridgewater in the US, actually on CNBC, come out and say that the Fed should be looking more at asset price stabilisation here, when the problem for us is that can be quite dangerous, because it's that communication tool that central banks have that needs to be effective. And obviously their price stability aspect is inflationary pressure, not asset prices. But again, we're in a very unique situation here where it's carrying a lot of assets on its own balance sheet. So there may be a little bit of purvey there from that point of view. But I think ultimately for us, it's a case that the Fed is talking a lot more hawkishly, but it also realises that given the ultra-low monetary policy environment for well over a decade, the economies and particularly corporates have geared to this environment. So any acceleration in monetary policy will have a more than magnifying effect in relation to effective investment decisions from the economy and from the public. So cost of corporate borrowing is already increasing. It just makes them in a very tenuous situation here to be able to accelerate.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.